It's Friday the 15th of November, and this is your Capital Economics Weekly Briefing. I'm David Wilder. Coming up, what next for the Trump bump after that post-election spike in stocks, bond yields, and the dollar? But first, Neil Shearing, Group Chief Economist, joins me fresh off a plane from New York. Hi there, Neil. How was the flight?
Hi, David. Bumpy too, but
New York. What was the mood in New York? It was a solidly Democratic city, but it is less blue than it was last election. What's the mood there?
it was interesting. I was reflecting on this with Paul Ashworth, our Chief US Economist, over the week. In 2016, I was actually living and working in New York with Capital Economics, so was there for the first Trump victory. And back then, the mood was one of shock, I think. This time around, I don't detect any of that shock. It's moved much more quickly to trying to figure out exactly which of the pledges and promises that were made on the campaign trail will make it through to a program for government, how much of this is rhetoric, what's the reality, and what are the key fault lines. And then, of course, what does it mean for the economy? What does it mean for markets? So I think less of the shock this time around, perhaps unsurprisingly, and moving much more quickly through to working out what all of this means.
Yeah, it's interesting, isn't it? Because, as you say, less shock and very quickly moving to gauge what's going to happen, what isn't going to happen. And really all we've had to go on so far have been these nominations for his cabinet. And some of those have been greeted with quite a bit of shock, certainly in Washington. And you can't help but be reminded that when it comes to Donald Trump, when it comes to these policy pledges, all bets are off, right?
Exactly. I mean, the week started pretty well for anyone that thought that we might get a relatively more orthodox Trump administration. So we had Marco Rubio announced as Trump's pick for Secretary of State, China hawk. So I think complicating relations, intensifying this rivalry between the US and China, but an establishment figure. And we had two in the race for Senate Majority Leader. John Thune prevailed there. Again, a GOP establishment figure, an ally of Mitch McConnell. Rick Scott, who's more closely aligned with Trump, failing to get past the first ballot. So it looked like at the start of the week that we were having slightly more orthodox appointments, and perhaps too that the Senate was reasserting its independence and might not be pushed around by a Trump administration. And then we got a succession of announcements on cabinet picks, the most striking of which, of course, was Matt Gaetz for Attorney General. So a week of two halves in some senses, orthodox appointments, establishment appointments and developments at the start of the week, and then at the end of the week, these more radical, unorthodox appointments that I think genuinely did shake parts of Washington.
So what does that mean in terms of policy? I know there's still weeks to go before Inauguration Day, before we get a much clearer view of what is going to happen versus what was pledged on the campaign trail. But the policy that's been getting most attention, certainly this side of the pond, is tariffs. As the reality of governance looms, do you think we're going to get a dilution of his more extreme proposals, 200% tariffs on Mexican cars? Is that really going to happen? But also, how would a blanket tariff, there's this 10% blanket tariff that keeps being touted, or maybe it's 20%, but how would that work in practice, and what would the macro effect be?
I think you hit on a good point here. The fact that we don't know whether it's a 200% tariff on imports from Mexico, or 100%, or even just a 10% universal tariff, or if it's a universal tariff, whether it's 10% or 20%, that there's clearly a huge range of different outcomes. And it goes without saying that a difference between a 10% tariff and a 200% tariff is enormous in terms of its economic and market impact. However, I think we can be reasonably confident about a few things. One of them is that we know that tariffs are coming, and I think they're likely to be set at higher rates and be wider in terms of their coverage than during the Trump administration. We know that the extent of executive authority in terms of being able to set tariffs is quite substantial. The Constitution, in principle, gives Congress the power to set tariffs and regulate foreign commerce. But we know from the Trump administration there are various mechanisms that the president can use to circumvent Congress, and I think that will happen. So we can be reasonably confident, I think, that tariffs will be higher, they'll be wider, and they'll be more prevalent than in the first Trump administration. Quite how high, quite how wide, quite on what goods, I think is still up for debate. A bit of context is useful. The US imposed a 10% universal tariff or import surcharge under Nixon in 1971 when the US came off gold, the so-called Nixon shock. Now, despite being a universal tariff, an import surcharge on all US imports notionally, actually, it only applied to just over half of US imports. And when we look at the different carve-outs for tariffs in the first Trump administration, the tariffs on China, 25% in many areas, but actually the average tariff rate now is about 12.5%. So I think if we're thinking about a 60% tariff on China, I think it's likely on some goods, but maybe carve-outs and so on and so forth, bring it down to a 30% average tariff. And if it's a 10% universal tariff, maybe that becomes a 5% average tariff once we've got various different carve-outs and exceptions. And obviously, other governments are trying to work out how they'll respond to this. And that's what we're seeing in Europe. How would Europe respond to the threat of a universal tariff? What could it provide to the Trump administration in order to diminish some of that tariff threat? So we're into the phase now where I think we know that tariffs are going to be higher, and other governments are trying to work out exactly how to respond to that. And as we work through that process, I think we're going to end up in a situation where they're not quite as high as advertised on the campaign trail, but still pretty significant nonetheless.
And isn't the other key point, because you mentioned the 1971 import tariff example, but then the tariff was brought in with an explicit goal of getting trading partners, Japan and Germany specifically, to adjust their exchange rates. Once that got done, once the agreement got done 3-4 months later, the tariff was removed. The tariff did its trick. Isn't the problem here that the intent is so unclear? Trump's spoken about tariffs as a way of encouraging investment to get factories and jobs back into the US. But he's also spoken about tariffs as a revenue-raising exercise. So because we don't know the intent, isn't it then that much harder to assess their feasibility, never mind the economic impact of it?
I completely agree. And I think there are two things going on here. One is that I think Trump, self-proclaimed tariff man, tends to view the macroeconomy through the lens of a balance sheet, in which case trade deficits are bad and means that someone's taking advantage of the US, never mind the fact that the US is benefiting from cheap imports. So the objective in that sense is to close the trade deficit using tariffs. And I think that's a one-way street to higher inflation. And there's not much, indeed any academic evidence to suggest that tariffs are an effective tool in closing trade deficits. The other thing that's going on here is the fact that Trump on the campaign trail pledged tax cuts, including corporate tax cuts. And we're in a very different place now to where we were in 2016 with respect to the room for fiscal expansion. So US deficits, 6% of GDP, about half that budget deficit's taken up now by interest payments. The federal debt burden is much higher. The Trump tax cuts of 2018 are due to expire next year. That's a $4.5 trillion over 10 years that needs to be found somewhere. So in other words, it's not just tariffs being threatened to or used as a tool to try and close the trade deficit, doomed that might be, is perhaps also a source of alternative revenue to fund tax cuts that have been promised on the campaign trail. Now, in terms of the economic impact of that, the tax incidence, the so-called tax incidence, so who pays the tax, is US consumers and US firms if it's a tariff. It's not China, it's not Mexico, as Trump often says. But so you'd be taxing consumers and perhaps US importers in order to provide a tax cut to US firms in the form of corporation tax. It was a redistribution. So there's not much macroeconomic effect there, but it might be that tariffs are going to be used as a tool to raise revenue to finance tax cuts elsewhere. So yeah, like I say, two competing objectives: the effort or the attempt to try and close the trade deficit using tariffs. I think that's pretty doomed. The use of tariffs to finance tax cuts elsewhere, I think that's more plausible, indeed, perhaps more likely.
What about the international dimension? You mentioned there that Europe's potential response to tariffs. Do you see economies like Europe and China retaliating when Trump slaps blanket tariffs on their exports? They're not going to take it lying down, are they?
No, you're right. They're not going to take it lying down. I think it also depends a little what you mean by retaliation. They will need to be seen to do something. Now, as you say, you can't take it lying down. The question is, how tough is the response? And by and large, governments in Europe and indeed China still believe in free trade, free and open trade. There's no big push to start global trade wars. Indeed, I think Beijing may even sense an opportunity here to position itself as the defender of globalization, if you like, in the kind of international imagination. So I don't think there's going to be a big push to retaliate on such a large scale that it invokes further response from the US and therefore risks triggering a global trade war. But as you say, these governments won't take things lying down. Now, what does that mean in practice? Back in the first Trump administration, Europe, for example, levied tariffs on imports of Kentucky bourbon and Harley Davidsons, which are manufactured in Wisconsin. So Rust Belt manufacturing, that didn't amount to very much in terms of a macro effect, but it was symbolic. And I think that's the type of retaliation we're likely to get. So that's the stick. And then the carrot will be, okay, we'll purchase more US goods. And what could those be? Energy would be an obvious one, to the extent there's capacity for the US to export more energy, particularly LNG. That would help to fulfill a strategic objective on behalf of Europe, that Europe has to decouple itself from a reliance on Russian energy. So yeah, potentially purchase to buy more US energy to the extent that America could fill that void. And the other promise would be to increase defense spending, which possibly to direct some of that spending towards the US in terms of US manufactured defense goods. I think they're the two obvious ways that Europe might respond. In the case of China, I think there's a three-pronged response. One is to allow the renminbi to weaken. Again, the degree of depreciation, devaluation would depend upon the size of the tariffs, but it's not inconceivable that the renminbi gets to 8 against the dollar at some point over the next 12, 18 months, given the scale of the tariffs that Trump is talking about. The second would be to try and, a bit like Europe, provide some carrots to the US in terms of the promises of potentially importing things like US soy, for example. And then the third prong of the response would be to impose some tariffs, retaliatory tariffs on the US. But like I say, I think they're going to be pretty limited, and they'll be in areas that are symbolic, on goods that are symbolic rather than economically important.
What about immigration policy? Because that's sort of the other big plank in terms of the campaign pledges and Trump's intent to remake the US economy. That's got to be the bigger economic threat, right? I mean, if you go back to what you were saying about appointments, people like Stephen Miller, they're not messing around when they talk about mass deportations of undocumented migrants. How is the US economy meant to operate without the millions of workers that they're talking about removing?
It's going to be extremely difficult, I think. And I think this is the part of the Trump platform that could end up being the most economically significant. There's uncertainty about the degree of tax cuts that Trump will push through. We push back a bit on the idea of widespread fiscal relaxation because of limited fiscal capacity to do that. Tariffs, again, there's huge uncertainty as to what they'll be levied on and how large they might be. But I think by and large, the lesson from the first Trump administration is that they don't have an enormous impact on the macroeconomy. Immigration reform and shifts in immigration policy, I think, could have a potentially quite significant impact on the US economy. So as some context, about 4/5 of the growth of the US labor force over the past 2 or 3 years has come through immigration, both legal and illegal. On the undocumented migrant front, we think there's somewhere between 10 and 12 million undocumented workers in the US. So a push to remove, say, 1 million undocumented workers from the US each year, which is what some advisors to Trump are talking about, and also to really clamp down on both legal and illegal migration, it's not impossible that could knock somewhere between 0.5% and 1% off of US potential GDP growth. So it's a really significant move. You're talking about moving potential GDP growth down from, say, around 3% now to closer to 2%. So that's quite a big move, I think. And that's something that's not yet featuring in many conversations. It's on the sidelines. Most of the focus is on tariffs and tax cuts. But I think immigration and reform to immigration is potentially a much bigger deal when it comes to the US economy.
And potentially inflationary, right? Because you've argued before that the common denominator through all of Trump's main economic policy pledges is that they pose upside risks to prices in the US. Given all that, and on that basis, how worrying, just to bring us back to the nearer term, how worrying were the CPI and the PPI releases out of the US we've seen in the past week?
Yeah, just back on immigration, less immigration, the removal of undocumented workers, that affects the supply side of the US economy, but migrants also spend, so it affects demand too. So weaker demand means less inflation pressures, less supply means more inflation pressures. I think one of the things we've learned through the pandemic is that there's lots of frictions involved when economies adjust to new equilibrium. Very often that can mean higher prices during that adjustment process. So I suspect that when we think about sectors that are very heavily dependent on migrants, construction, leisure, hospitality, food and food processing, we're going to see higher cost, higher prices in that adjustment process if we get the kind of the reduction in migration and the removal of undocumented workers that some people are speculating about. Now, just on the near term, you're right that if we look at the latest data, there's now, I think, clear evidence that over the last couple of months, inflation pressures have started to tick up a bit, underlying inflation pressures. Now, there's perhaps some one-off factors involved in that pickup, but it's worrying nonetheless, I think, if you're the Fed. And then I think if you're the Fed, you might be more willing to chalk it down to 1 or 2 months of one-off factors. If there wasn't this prospect of potentially tax cuts and tariffs and immigration reform and all the frictions involved in that coming down the track. So a much more difficult environment for the Fed. And I think we've started to see that reflected in some of the comments coming out from Fed officials over the past week or so, perhaps just doubling down some expectations for aggressive rate cuts. I still think on balance, another 25 basis points cut is more likely than not in December's FOMC, but it's pretty clear from the tone of communications over the past week that's far from a done deal.
Neil Shearing there, semi-fresh from the airport, on what to expect when Trump is back in the White House. We are continuing to add to our coverage of this pivot point in US policy, and our dedicated Trump page is your gateway to our complete analysis. Just in the past week, we've published insight on everything from the impact on oil prices by way of the Israel-Iran conflict, whether and how the Ukraine war will end and what that would mean for macro, and what a higher for longer 30-year mortgage rate will mean for the US housing market. I'll add that to the podcast notes. There's also our key analysis on the market impact of Trump's return. In a world of speculation about what Donald Trump may or may not do, markets have not been waiting to see. Equities, yields, and currencies began moving as news trickled in on election day, and US equities hit record highs, treasuries sold off, and the dollar has strengthened considerably in response to the news. Our end 2024 S&P 500 target of 6,000 was breached at the start of this past week. When we published our US equities forecast in the middle of last year, there was a lot of skepticism around because it was seen as far too bullish. Well, here we are. Anyway, there have been signs that at least some of what's being called the Trump bump has been running out of puff. So I spoke to Jonas Goltermann, our Deputy Chief Markets Economist, about what comes next. And I started by asking him to bring us up to speed on where this trade is now.
I think it's fair to say we're past the first stage, big swings and the sort of initial euphoria, if you will, and into maybe a second stage of a bit more consolidation, settling down. In some cases, maybe second-guessing some of that initial reaction. The equity market in the US, for example, has come down a little bit over the past couple of days. That's broadly similar to what happened in 2016 after Trump's first win, and to some extent also after the 2020 election cycle. You get a first move and then a bit of a consolidation phase. I'd say, broadly speaking, most markets have played out as we, and to be fair, most others had expected they would in the event of a Trump win and a Republican sweep. And overall, it's pretty similar to 2016. US equities out, the rest of the world not doing quite as well. Small caps in the US doing particularly well. In bond markets, you've seen bond yields rise pretty much across the curve. And the curve has steepened a little bit, although maybe not as much as I would have expected on that front. Currency markets, you've seen the dollar up quite a bit and across the board against pretty much all currencies, which has actually been the strongest and the most sustained move. Not so much second guessing going on in currencies, at least not yet, which makes sense. Tariffs are obviously one of the main tags on Trump's platform, and if implemented, they would have a pretty significant impact on currency markets in particular. And what's more, the election builds on a trend of where we've seen stronger US data, weaker data elsewhere. So the underlying direction of travel was already, or in any way, regardless of the election, was towards a stronger dollar. So I guess you could say there's been an adjustment process to new information over the past week and a half. We're trying to settle on you might think of as an expected value for fiscal policy, for tariff policy, and all the rest of it. Taking a bit of time, probably has another week or two in it before we can really settle and go back to the regular macro. Obviously, December, you got payrolls, inflation, Fed, ECB, BOJ, and so on, the usual stuff. So now, in terms of the Trump stuff, there's only so far you can go on expectations alone, I think. Make an educated guess of what's going to happen. And all these nominations and whatnot that's coming out over the past few days gives a little bit of an indication of the plan. But for the most part, I'd say it's a phony war for the next couple of months until Trump actually takes office and we find out a bit more about what is the actual priorities, what is the plan, and what can they actually get done, get to Congress and so on.
That's what I was going to ask, because certainly the move in equities that we've seen, is this a rational response to anticipated policy changes, or is this just speculation?
I would say it's a bit of both. There usually is in equities. If you look at bonds and currencies, I think, like I said, I think a lot of that makes sense. In equities, the overall move that equities should go up, that also makes sense. Obviously, there's been some pretty frothy stuff in some of the smaller names. But overall, you think about the most concrete policy that affects US equities is what happens to corporate taxes. Trump says he wants to cut them. Harris wants to raise them. Congress would be a constraint on either of them, but clearly a Republican sweep means that the expected value, if you will, for the corporate tax rate in the US has gone down. And that's good news for US stocks. It's a pretty direct mechanism. So if the corporate tax rate were to be cut to 15%, which I think is roughly what Trump has said, that probably is worth something like 2, 3, maybe 4% on after-tax earnings for the S&P 500. Not a huge deal, but it's clearly a positive and a very rational reaction. If you think, even if you don't know the tax cuts are going to happen, and we don't think they actually will, but the expected value is not zero. That has changed as a result of the election. But then there's a lot of other stuff that's a bit more nebulous. So one thing you hear a lot about is deregulation. That's, it certainly has a pretty tangible impact in some sectors. I think banks probably are the best example of that, and the banking sector has done particularly well since the election, which makes sense. But yeah, for the market as a whole, I wouldn't appeal to deregulation as a sustained boost. It's really hard to identify tangible things that are going to really move the dial at a macro level. I know it doesn't always feel that way, but the US is actually already a fairly lightly regulated economy in many ways, certainly if you compare it to other big economies. And the other thing, of course, with Trump's policies is that not all of them are good for equities. Tariffs, I think, are the obvious example on this front, but you think about his immigration approach as well. Tariffs are probably worse for equity markets in other countries. Certainly that was the case back in 2018-19 during the first US-China trade war. But I think overall they are a negative for the US market as a whole. So you have a balance of pros and cons, and right now we're focusing on the pros, but that could change.
When we're talking about equities, we've had this view for a while about where we see earnings going, where we see valuations going, and what that means for prices. Does that change now that the political outlook has changed so radically? Are earnings and valuations still on the path that we set out in the middle of last year?
So I don't think it changes all that much from that underlying trend. In general, we think the impact of politics on the economy and any financial markets, it's often overstated. The US economy is tracking along pretty well right now. Earnings growth has been strong, especially in the tech sector. And that probably continues in the near term, probably would have continued under a different political outcome as well. I think the combination of tariffs and immigration restrictions, it might become a bit of a headwind next year, and the US economy, arguably, it's maybe overdue a slowdown at some point anyway. And we also don't think there's going to be a big fiscal stimulus package or another round of major tax cuts beyond extending the 2017 tax cuts, which are due to expire next year. So not another big boost. That's mainly because the US federal deficit is already very large. It's going to be hard for Congress to justify a further fiscal expansion at this point. And there's also a chance the bond market kind of puts it foot and then says no, as has already occurred in France and the UK at the past couple of years. The other point in terms of valuations, they're already very high in the US. They're more than 20 times 12-month forward earnings, which is about as high as they were back in 2021 before the 2022 bear market, if anyone still remember that. It's also a lot higher than in 2016 when Trump first came in. Price earnings were in the mid-teens back then. Now, in the short term, valuations can go higher, and we think they will. But on a medium-term horizon, say 5 to 10 years, valuations, I think, are a pretty strong reason to temper your expectations for stock market returns.
Okay, medium-term reasons to not get too excited, but talk about near-term. Talk about what's going to be driving equities from here on in. Is AI still going to be one of the dominant themes, but also what are the risks to this bubble that we've identified in the stock market?
I think the thing about the AI narrative, it's been a bit less front and center over the past couple of months and past few months, really, since the summer. And we've not got all the way back to all AI all the time situation that we dominated back in the first half of the year, especially in Q2. But the underlying trend, I think, is still there. It has further to run over the next year or two in terms of the stock market. Valuations are high, but they can go higher still. We're still some ways below the sort of peaks that we've seen in the dot-com bubble or in other bubbles in terms of valuation. So we're sticking to our call that the S&P 500 will end at 7,000 by the end of next year, built mainly around an idea that the AI bubble has further to run. Now, there are obviously risks to that. I think for the most part, they're the same now as 2 or 3 weeks ago before the election. The biggest one is just that AI doesn't quite pan out as well as people hope and expect, especially in terms of being actually profitable. It's still the case that for the most part, profits are being made by suppliers of AI chips, NVIDIA, first and foremost, but that whole supply chain, that's where the money's being made. And we need to see that broaden out such that there is a big return on investment in all the AI chips and data centers there. The other parts of the Mag 7 are making, and they need to be able to show that's translating into profits for them as well, and that further down the chain as well for the stock market as a whole. I guess with Trump taking office, you maybe add tariff policy to the list of risks. Thinking about 2018, that was a pretty mixed year for stocks in part on account of the first US-China trade war. Next year, if you see a bigger trade war, if it spreads and becomes more of a global trade war this time, that could sour sentiment and that would undermine potentially the stock market. It's not our base case, but it's certainly a significant risk.
Before you go, Jonas, I just have to ask you about the dollar. That's another big story here as markets have adjusted to news that we're going to get a second Trump term. President-elect has a very public desire for a weaker dollar, but the dollar has strengthened a lot since he won. How do we square that? What do you think Trump's play is going to be here?
You're right. It's a bit complicated. We've actually put out a note just earlier this week explaining why we think the dollar is now going to strengthen further next year. Right now, we've seen a sizable appreciation since the election and actually in the run-up to the election as well, which has taken the dollar to the top of its range. The range has been since 2022. That's partly on account of the election result and anticipation of the election result, but also just the fact that US data over the past couple of months has been mostly pretty strong, while Europe in particular has been faltering. So we'd expect some consolidation into year end. So that's the norm after this sort of sizable move that we've seen. But we've penciled in another 5% or so of dollar appreciation next year, with the euro heading back towards parity and the renminbi weakening significantly, the dollar renminbi rate going to 8 in our forecast. Tariffs are the main reason for that view. We think they're going to happen, which doesn't seem to be priced in fully yet. And we think they're going to happen in the first half of next year, based on the assumption that Trump will be able to put through these tariffs using executive orders, and also that he means it when he says he loves tariffs, and they're not just for negotiation, which he actually means to implement them. Fair bit of uncertainty around that, obviously, but provided that tariffs go through as he set out, we would expect a considerably stronger dollar. As you say, Trump also says he wants a weaker dollar, and the dollar is overvalued. And he's got a point there, to be fair. So the dollar is probably 10-15% overvalued on a longer term basis, in our view, and that's, I think, a view that's pretty widely shared among analysts. But the problem is his policies, tariffs, and to the extent he gets anything through on fiscal, that would strengthen the dollar, not weaken it. So there's a clear tension there. He could try to talk the dollar down, which he tried to do in his first term, but it tends to not have much of a sustained impact, certainly the first time around. The more concrete options include direct intervention in currencies, either unilaterally or in coordination with other major economies. You could even imagine tax on capital inflows or outright capital controls, which again could help sweeten it all a bit. Those are pretty more extreme measures and not things that he has mentioned so far. Now, I think most of these options would be hard to pull off successfully. Not impossible necessarily, but quite tricky. Intervention's the most obvious option, but it has a pretty mixed track record of success. You'd also need to get the Fed on board, which is a whole separate conversation, really. Getting a multilateral agreement, kind of a Plaza Accord 2.0, maybe you call it a Mar-a-Lago Accord. That seems like a pretty tall order, especially since you'd have to involve China. US-China, obviously, rivals, not friends. It's not impossible, but it seems like they're pretty long odds. I'm really for getting that through. Think about restrictions on capital flows. As I said, those are more extreme. It would probably require legislation, and it would definitely face a lot of opposition from the US financial sector, so that one seems unlikely as well.
That was Jonas Goltermann on Donald Trump's limited options to get a weaker dollar. As he suggested, the markets team has done a lot of work making sense of what Donald Trump's re-election means for FX. He touched there on our new forecast, renminbi at 8 to the dollar. That would be its weakest since 2006, just after the 2005 reval. and the euro at parity. I'll post all of the key bits of analysis in the podcast notes, along with a link to our interactive forecast dashboard so you can explore them for yourself and download what you need. There's another busy week of data ahead, including flash PMIs for November, but there's also NVIDIA Q3 earnings. We don't cover individual stocks, but if there is anything in that report that speaks to a shift in the broader narrative around AI hype as a driver of the stock market, then we will be all over that. But that's it for this week. Neil and I will be back next week to bring you more from the front lines of macro and markets. But until then, goodbye. Whilst this podcast is provided with all reasonable skill and care, it comprises the subjective views of our economists. Furthermore, these views are not opinions, nor do they constitute investment or financial advice, or are they guarantees or reassurances to the expected results of any investment products or outcome. You should seek your own specific advice in relation to questions you may have. We will have no liability to you in relation to this podcast whatsoever.